Calculating depreciation using straight line method. On 1st of Jan 2003, building had cost 250,000, whereas the provision for depreciation for building is 22,000. You had been asked to calculate depreciation using straight line method at 10% at the end of the financial year, which is 31st 12/2003. Now we have a specific formula to calculate straight line method of depreciation. You take the cost of the non-current asset and you find the percentage which is mentioned in the question. So the cost of the building here is 250,000, whereas the percentage of depreciation is 10%. And 10% of 250,000 gives 2,500. Now, first of all, we should know how to post the double entry to a general journal. Usually, we take the end of the year date, end of the financial year date, and then we debit the income statement as calculated 2,500 and credit in provision for depreciation by 2,500. Now let's see how it can be transferred to a ledger, which is building provision for depreciation account or a ledger. So first of all, we enter the opening balance of the provision for depreciation of building. Provisions usually have a credit balance. Therefore, you enter it on the credit side of the ledger as at 1st of Jan 2003, and usually the opening balances are written as brought down BD. Depends on whether it's debit or credit. And then this year we have calculated depreciation, which is 2,500, which is as at 31st December 2003. In the detail column, you write it as income statement. Now you know from where we have derived the information. Now let's focus on how to balance the ledger. Now you can see that the credit side is greater. Bring down the balance. Again over here. And total take away 0 gives the same answer, which is 24,500. End of the financial year date as balance carried down. Then you take it to the opposite side. The next date, 1st of Jan 2004, as balance brought down, 24,500. Please note that you are not supposed to write anything for the date and detail column in the total. Let's see how to post entries to the income statement. So, in income statement, write depreciation 2,500, and then type of non-current asset is building, and the cost. We derived the information from the question, 250,000. Let's post the cost of building. And the accumulated depreciation, which is 24,500, which you derive from the ledger. Now you find the net book value by finding the difference between the cost and the accumulated provision for depreciation. Accumulated means the total depreciation, which gives you 225,500. Now to recap the lesson, first of all, we understood the question, identified the method of depreciation to be calculated, identified the formula, calculated depreciation, we transferred information to the general journal, and then we posted entries to the depreciation ledger, opening balance and current year's transfer, it has carried down, brought down, and then we have transferred the information to the financial statements such as income statement, and statement of financial position. Building depreciation is written under the category of expenses in the income statement, whereas in the statement of financial position, you mention the type of non-current asset, the cost of the non-current asset, and the accumulated depreciation, which is also the closing balance of the depreciation ledger, and then you find the net book value. The net book value is the difference between the cost and the accumulated provision for depreciation.